So here's the thing, when I talk about trusts with small business owners, I get one of two responses. The first is, this is black magic, I've got no idea how any of this works. The second being, whatever nerd, do what you need to and just send me the invoice. The reality is though, that if you understand how a trust works, the possibilities open up to you in a very, very meaningful way. So strictly speaking, a trust is just a container in which you can hold assets, shares, managed funds, investment properties, even a whole business. The difference between a trust and any other entity is that it separates the legal and beneficial ownership of the asset. If this doesn't make sense to you, let's break it down to first principles. So as legend would have it, trusts began in the days of the Crusades. Bear with me now. When a knight would go off to war, he would leave his assets in the trust of a friend. If he died in battle, those assets would go and help his family. If he came back from battle alive, he'd get those assets back. Fast forward several hundred years, and accountants, architects, lawyers, and doctors all use trusts for different purposes. Take, for example, a surgeon. Now, he's really good at what he does, but he runs the very real risk of being sued. So what he does is he takes his investment properties and puts them in a trust. If he does get sued, and although he does have insurance and a great legal team, people can still access the properties if they're in his name. Because they're in the trust's name, they can't directly access them. This feature of a trust is known as asset protection. Another really popular feature of a trust is tax minimization. So let's take our surgeon from before. He's on a salary of about $300,000 per year, which puts him on a tax rate of about 45%. If he made $100,000 in revenue off these properties normally, he'd pay about $45,000 in tax. If they're in a trust, he can divert this income to his wife and his son, both who aren't earning any income. So they'd each make $50,000 and get taxed in total about $15,000. This saves him $30,000 per year just by restructuring his assets. At this point, you're asking, is this legal? And how come more people don't do it if it's so good? Well, to answer your first question, it's very legal. In fact, about 50% of coalition members of parliament use a trust compared to 5% of the general population. So how come more people don't use trusts? The reality is that trusts can be complex, and it is easy to get them wrong if you don't know what you're doing. So the people who do have trusts are the ones who can afford the $300 to $400 per hour that an accountant or a lawyer would charge to set these up. Thankfully though, we like to do these videos for free, so if you enjoyed this video and learned something from it, please give us a like or subscribe or follow us on whatever network this is being shown on.